Hey everyone, today we're going to be going over just a little bit of market analysis in this short 5-minute video. And the premises of this is basically just to, for newer traders to figure out, ways that you can use fundamental analysis to make, better informed trades. I refer to the onion in the educational tab of the terminal for what I mean. Every single piece of, whether it's stock or ETF volatility is exposed to broader market volatility. And second, just, to help you guys keep a pulse on the market if you're too busy to keep up on that. So that's what we're going to do. Obviously, last week, the big story was the Fed hiked 25 basis points to a range now between 4.75% and 5%. And this sounds bearish on the surface. However, looking at how the market took this. Last week in markets, we actually saw bond yields on the 2-year collapse. I mean, we saw bond yields go from around 4.2% all the way down to 3.75%. And this wasn't just on the 2-year, this was also on the 10-year. We saw massive drop-offs in bond yields. So what this essentially means is that a lot of the pressure that we saw on the S&P 500 and these bigger, the whole broader market as a whole was due to the banks, right? And the banks were falling off a cliff. If you look at the price of just XLF, you'll see this. Even though XLF isn't even a regional bank or a regional banking exposed ETF, we still saw a massive drop off in XLF prices. So the general gist here is the reason that this happened was because these bank failures was driven by the losses that they had on their bonds, which lessened their liquidity, right? So now these bond positions are starting to slowly improve. This might alleviate some of that stress. But the bigger thing for me is that the market appears to be a little more risk on because now we're starting to see bond yields come down and, broader expectations coming up. And we can further validate this by looking at risk on and risk off commodities. So an example of a risk off commodity is going to be gold, right? Gold is the standard run for the bunker tinfoil hat commodity. And what we can see is that gold actually closed down on the week as indicated by the gold shares ETF from Spider. It actually closed down on the week by around, 7 basis points. So nothing really crazy there, but more risk on assets like oil, as indicated through USO, actually closed up around 4% on the week, rising from levels of around, $58 to almost $61 at the close. So what does this mean for the broader market, right? If we're seeing risk on, we should expect volatility to have come down, and that is what we got. We saw volatility this past week on the S&P 500 for the next 30 days decrease from 21.1% all the way down now to 19.58%. Not a significant, gigantic drop. However, remember, this is the entire market as a whole. So, with all this being said, looking at just broader market, relative value in terms of IV30 versus the realized volatility, we can actually see that in the percentile terms, we're below the average, right? We're in the 38th percentile. So, at a ratio that stands at 0.99. What this means is that, the risk premium, the market really isn't putting a whole lot of risk premium out there right now in the broader market. So what this could mean for you and individual trades that you take, this could signify that, hey, market volatility is relatively low. Maybe it's not a good time to enter into a position that has a very high beta to the market. And the way that you can always check that is just by doing your standard regression analysis on a company. So, for example, Apple has a high beta, right, of 1.263 to the S&P 500. That might be a name that you might want to consider taking a look at. Or, like I said, with the risk-on assets like USO, if you think that this is the end of the market volatility that we've been seeing, then obviously, this might indicate, maybe I factor this in less. But if you think that, we're not out of the woods yet, it probably wouldn't make sense to sell on a name like Apple given the higher beta and that market volatility might rise from here if that is your view. Also, this could also coincide with those commodity names like I was mentioning earlier. Let's use an example like XOM to signify that. What we get here, guys, bang, beta of 0.7. You may think that that might be a better play than in that regard. So again, this was just a quick overview of what's going on in markets and how this can be useful if you're a newer trader trying to figure out, when from a fundamental perspective, it might be a good time to take trades. That is all I have for this one today, guys. Enjoy the weekend and take care. Peace.